Hello everyone and welcome to Money Reimagined, the ESG edition. I'm Michael Casey and I'm joined by my regular podcast co-host, Sheila Warren. This is the first episode of 2 in which we'll discuss a hot topic on both Wall Street and in the crypto community, ESG, the idea that companies and investors should set environmental, social and governance objectives to promote global sustainability. Now, it's true, the crypto industry faces challenges in this area. Just look at how Elon Musk stirred concerns about Bitcoin's carbon footprint. But it's also true that blockchain technology holds potential to improve ESG efforts. Today and tomorrow, we'll dive into that mix of challenges and opportunities. I'm excited for this, Sheila.
So, Michael, I should note that the idea for these sessions actually comes from a special project spearheaded by the World Economic Forum in partnership with CoinDesk. We're setting up what we're calling the Crypto Impact and Sustainability Accelerator, or CISA, which will house at the forum and bring together a variety of stakeholders from sectors as varied as finance, tech, accounting, government, civil society, academics. The goal being to support open source, market-driven approaches to ESG, all within a common commitment to interoperability and compliance to international targets. So our sessions on ESG today and tomorrow align with CISA's soft launch, and we'll formally announce the group's founding membership in the fall. I'll also note that our guests today and tomorrow aren't necessarily here because they've made any formal commitment to the CISA project. They're really here as experts to help us get this vital conversation going.
Okay, so with that, we start with what is arguably the most urgent of ESG objectives, containing climate change. In the 2015 Paris Accord, governments committed to bring the net amount of greenhouse gas emissions down to zero midway through this century. Here's the problem. How do we measure progress? We need a uniform, transparent, trustworthy accounting model that's consistent for everyone. In essence, we need a common planetary carbon ledger. Who would maintain such a ledger? Or is this a case for a decentralized model offered by blockchains? To discuss this, we're joined by Massamba Thioye from the United Nations Framework Convention on Climate Change, commonly known as the UNFCCC. He's also the co-chair at the Climate Change Coalition. And we also welcome Martin Wainstein, founder and executive director at the Open Earth Foundation. Welcome to you both.
Hi.
So, Massamba, why don't we start with you? Please talk us through some of the high-level global challenges that exist in terms of measuring and accounting for this massive collective undertaking.
Thank you. One of the most important challenge that is faced when it comes to climate policy making is to be able to measure the impact of climate action, or to measure the, to account for ESG emitted by an entity. This is the basis for developing policies. For example, if you want to incentivize, you need first to account. Now, what happened is there are type of accounting that are quite well known, well established, where actually new digital technology can help improve. But these are things that are already in place. However, there are areas where we need actually to have some enabling technology to be able to do what we want to do. So, for example, when we would like to take a need-based approach for ESG accounting, when we want to have an approach for ESG accounting that is based on consumption and not on production, we have a very, very important challenge, because you will need to measure the carbon footprint of product using life cycle analysis. And we do not know how to do it in a way that is transparent currently. So this is in this type of area where the new digital technologies such as blockchain can be extremely helpful.
Thank you. Martin, you've also talked about the need for a uniform, interoperable model of climate accounting. And how do you think we achieve that? And how do you see blockchain technology fitting into it?
Thank you. And it's really a pleasure to join all of you in this panel. I'd probably start by saying there is a global accounting system, and that is housed at the UNFCCC in some sense. Every country submits their inventories abiding by the IPCC guidelines. The issue, and that's the heart of the Paris Agreement, it pertains between sovereign nations, the parties to the UNFCCC, and the Secretariat, the UNFCCC. So what happens with companies, what happens with subnational governments, and even individuals, which are geographically nested within countries. So part of our work at Yale and the Open Earth Foundation has been, we probably need to think about a nested climate accounting system where we're all housed within a broader system, let's say a subnational government and the country. When it comes down to companies, their operations can traverse multiple different regions. It is imperative to be able to create a lot more automation and efficiency in how all this data aggregation works without creating double counting. That we focus on the interoperability, and a lot of that work is now leading to perhaps some of the core aspects of interoperability in blockchain, which is decentralized identifiers and verifiable credentials, which have the capacity to showcase something that historically has been really hard. How do you convey transparency alongside data privacy? And so when we're able to connect the data from supply chains that Massamba was describing, understand the full footprint of a corporation, and being able to verify that almost instantly by an auditor, and then roll that data up into the jurisdiction in which those operations and that entity lies, it would simplify the process of creating national, international inventories almost to an immediate level. And it's almost like looking into the block explorer. And that's, I think, where we should be sort of aiming at all the tools that we have now in play. The challenge is putting them all together so we all speak the same language.
So Martin, what is also needed, of course, is innovation, right? There's so many different challenges, so many different aspects to this. How do we encourage that? How do we find a balance whereby we're encouraging this competitive drive to innovate, but at the same time maintain common standards that, as you say, roll up into this larger objective?
Well, there's many ways to answer that question. I think it's a great one. First, I believe we all need to be part of the same system, because we are part of the same system. Everything we do is housed within our atmosphere. So no matter what accounting we do, it all ends up into what we understand as our carbon budget. So once we're able to find a way in which individuals, companies, subnational governments, and sovereign nations are part of the same accounting and accountability network, probably that won't be housed in official settings. It has to be almost like an independent network. Probably the best way to tackle this is to have constant readability and consensus on the state of that carbon budget. And that is literally derived from the state of the art of science. Our network of sensors that tell us how much CO2 we can still put in the atmosphere. If we're able to map all of ourselves as climate agents into an interoperable network and are able to derive information from the state of the planet, there's all kinds of rule setting we could create, such as carbon pricing that's defined by the physics of planet Earth, not purely by arbitrary sort of economic calculation. And I think that's where a lot of the innovation might lead. But to be able to achieve all of that, we require very robust open innovation frameworks, open source, understanding what we often call beyond intellectual property into intellectual stewardship. Intellectual stewardship agreement for planet Earth as a core digital infrastructure to be able to achieve all this.
Massamba, clearly a critical part of this community is, of course, the public sector and governments, whether subnational or at the national level. How supportive are governments of making this information open and transparent, and maybe even using blockchain solutions?
It's clear that if we want to enhance transparency, the digital technology can help a lot, particularly blockchain. So if we want to have transparency at all levels, meaning at the level of government, at the level of subnational, but also at the level of individual citizen who could be also a climate actor, and more importantly, if you want to give access to the climate action schemes as well as to the incentive to all type of entities down to the level of individual, we need to have a robust, transparent system that will allow to measure the climate contribution of all these different entities, be it a state, a nation, be it a subnational like a city, or an individual citizen.
So, Massamba, in the crypto community, there's a view that open public blockchains are far better for driving innovation than closed private networks. But that's often a challenge for companies and for governments. How amenable are those entities to this idea of a public infrastructure?
I think as long as the balance between transparency and ensuring that confidentiality is not, there is no breach to confidentiality is addressed, it's not a big problem. Where I see more maybe an issue is this issue related to the consumption of energy. When you have permission ledgers, it seems that the consumption of energy is much lower than in most of the open one. But I think when it comes to transparency, it's as long as we can manage the issue of confidentiality, it's everybody is happy to have enhanced transparency.
So Martine, this is going to take a multi-stakeholder ecosystem-wide effort. Could you tell us briefly about the Open Earth Foundation's, your collaborative approach to climate tech? And do you think that these fiercely competitive tech providers are going to really be willing to come together and collaborate?
Well, we have to. So we come with an ethos of radical collaboration. Our work as a nonprofit was to establish the important area of research, development, design of open digital infrastructure for better Earth system management. And not because that's something easy to do, particularly because it's hard and because we need it. And we have to look at the Earth system first, and then being able to understand that in some ways, particularly in the climate accounting space, a lot of entities and new startups are building their own websites, but no one's building the internet in some sense. This is just an analogy. And so it is very important that we draw out the lessons of the last couple of years in the distributed ledger technology space to say, how do we create that common infrastructure? The reason why I think I'm optimistic that entities would collaborate is because we've also advanced a lot into how business models can be sitting on top of open source infrastructure. And so it's not either you define your business as open source or not, you can still have your proprietary enterprise grade solution sitting on top of an open source infrastructure that actually has the ability to establish queries and trust the information that your app layer is providing through that, let's say, zero knowledge proof information and verifiability. And it kind of links a bit to the other question of permission blockchains and permissionless. They have to all be part of a common system. And obviously, in permission networks within supply chains, the trust between the parties that are relevant to it is very key. But then put together, all of that could be transparently reported, not into the raw data, but data derivatives into the permissionless infrastructure.
So much to unpack there, but that's it for now. Thank you to Massamba Thioye from the UNFCCC and to Martin Wainstein, Open Earth Executive Director. Okay.
Thank you.
Coming after the break, seasoned investor Kevin O'Leary talks sustainable investing. Welcome back to Money Reimagined, the ESG edition, where we are exploring the roles for blockchain and digital assets in achieving global sustainability goals. Before we welcome our next guest, Kevin O'Leary, let's take a look at the crypto markets. So let's do a quick check on Bitcoin. The CoinDesk Bitcoin Price XBX Index is currently trading at 38,222. That's up 16.76%. We had some nice news earlier on Consensus from Ray Dalio suggesting he is investing, or saying that he's investing in Bitcoin. That may have helped there. And Ethereum up 33.45% at 2,561 currently. Right. So, okay, before the break, we spoke about carbon accounting. Now we move to Wall Street, where assets under management are sustainability-focused funds are nearing $2 trillion. Joining us is O-Shares ETF chairman and Shark Tank investor, Kevin O'Leary. Welcome, Kevin. So it looks like we've lost Kevin. So, Sheila, I mean, I think what we hope to be talking about with him soon, hopefully we'll get him back very soon, but just how big now this ESG issue is becoming on Wall Street. It's been a remarkable shift in a very short period of time in which it has become such a central topic, and of course that's relevant to how this technology interfaces with it. It sounds like we may have...
It's certainly something that at the forum we've been talking about for quite a while. I mean, we have been speaking about this topic and watching its kind of rise in terms of prominence and importance in a variety of different industries. And so I suppose it's time that it came over to crypto as well.
So I believe we have Kevin now, is that correct?
Okay. Yes, you do.
Thank you, Kevin. Thanks for joining us.
Hi, Kevin. Thanks for joining us. Hey, Kevin, so you recently said on CoinDesk TV that institutions' ESG committees are, in fact, taking a harder look at crypto assets specifically and demanding better compliance. And of course, that conversation's only heated up since then, especially around Bitcoin. So we'd love to know, what's your take on the current view in ESG in terms of the sector?
You know, this is all a good thing, and I'll tell you why. It shows you that the institutional allocation committees and sovereign funds and pension plans and large institutions who really have been ignoring crypto for quite a long time. I know we're all very excited about it, but the truth is that less than 1% of institutions globally actually carry it as an asset class at all. So we're just at the nascent beginning of this interest. And as you know, and it's been discussed quite a bit in the last few weeks, most of these institutions have both ethics and sustainability committees that filter offerings before they're allocated on the investment committee. And they're doing the same thing with every asset. They're not just singling out crypto or Bitcoin or Ether. It doesn't matter. They're doing it with every asset. And so the fact that they're going through this process, I consider a very positive sign. And now we have to find a voice. The industry that mines Bitcoin specifically needs to find a voice to talk about the things they do that actually help build sustainability into energy. I mean, obviously when you're mining coin, you want the lowest cost of energy you can get, and that makes you invest capital in finding it and finding sustainable ways to have it so that you can mine in the most profitable way you can. The profit motivation of mining Bitcoin is actually helping sustainability, but that voice is lost in the criticism right now, particularly after New York threatens to put that 3-year moratorium on Bitcoin mining, and then you heard from Elon, and then all the institutions chimed in. We have no voice. Miners have no voice. That's the problem currently.
So Kevin, so a voice is part of this, but presumably there's some very specific things that, whether it's miners or developers of digital assets in particular, can do to try to ensure that they do meet these demands of ESG investment committees. What kind of things should they be focused on?
Well, if you're in Kazakhstan burning coal to make Bitcoin, not so good. That's obvious. Obviously, every sustainable committee is going to say, no, we don't want that. We've got to find a different way to do it. And I think a lot of the energy now, and there's more and more of this conversation and dialogue occurring, is to go to the institution itself and say, I'm a Bitcoin miner. I have a sustainability mandate. I am in sync with you. I am going to mine my coin sustainably. Here's my energy source. Here's how I do it. Here's where I mine it. And you can buy my shares if I'm public, or I'm private. You can invest in me, and I will hold that coin on my balance sheet for you. You will know its provenance. You will know it was mined ethically. You will know it was mined sustainably. And we together can build this business together. That's after you as an institution decide to put 3 or 5 or 6% into Bitcoin in the first place. And there's a lot of excitement about Bitcoin. There's no question. It's the one that most institutions are talking about, even though as a community, the crypto community has lots of other opportunities. Right now, the institutions are interested in being exposed to the volatility of Bitcoin, but they've got to resolve this problem. And I think there's some very interesting research going on now, and indeed investments, and I'm part of it, to try and find a way to tag a Bitcoin, a coin itself, that to prove that it has a wrapper around it, that it came from a sustainable miner. And this sounds out there, but it's being worked on right now because that's what institutions want. And when that dam gets released, the amount of capital that will come into Bitcoin, it'll be the reason it goes to 100,000, 200,000, and all the dreaming that's been going on around price appreciation. That's not going to happen until institutions start to buy it. So everybody's got to wake up and realize there's demand, but it's got to be done around ESG concerns.
So to your point, there definitely are some really exciting projects and data and high quality research on these topics. But the reality is, at least right now, the debate around Bitcoin's carbon footprint is really it's happening in these overly simplistic talking points on both sides. And so some of us really believe there's a critical need for more nuanced, sophisticated dialogue on what's possible and what's not possible. What do you think can be done to help shift the narrative?
Well, the narrative is going to be shifted by the market itself. I mean, obviously, there's a lot of miscommunication and a lot of mistruths about it. The fact that there are miners in China and other places in the world, Iran, Iraq, Kazakhstan, et cetera, that are not really concerned about ESG issues because they've never had to deal with it, but they're still profitable miners. New mining operations, new investments in mining are very, very, let's call it, hip to the issue. They get it. And particularly if they're going after institutional capital, there's many deals in the market right now that are trying to raise $100, $200, $300 million to build out facilities in a sustainable fashion. So, obviously this is a very new issue. It's probably only 4 months old, but it's becoming a big cry from those institutional investors. And the community itself, there's many different views, there's no question about it, but this issue is not going away, that's for sure. And if you want to unlock, as I said earlier, the power of the institutional dollar, the billions and billions of dollars that would be coming into Bitcoin alone, if it was in a way that would be part of the mandate for sustainability and ethics, that's what really unlocks the power. So everybody that owns Bitcoin today, regardless of how it was mined, is incentivized to solve this problem for one reason alone: price appreciation. This is not brain surgery. Everybody can figure this out, price and demand. And to ignore it and to say, it doesn't matter is a huge mistake. And I think over time, particularly over the next 24 months as the new deals, every deal I look at now to invest in a miner, just let's stay in the mining sector for a moment, it's the number one question I have. How are you dealing with the ESG issue? What is your plan to that may want to own your stock down the road just to have exposure to your coin? What are you doing about it? Are you taking off flared gas? Are you new a hydro facility for hydroelectric? Are you going to new geographies where there's very, very sustainable low-cost power? What's the plan? And I'm glad we're having the conversation. I'm glad you're focusing on it because it is a very big deal.
So it sounds like you think this is very demand side driven. Do you think that there's alignment in these investors? Do you think that they agree on what it is they want to see?
Well, it goes from a baseline of don't burn coal, don't do harm, to let's find the most profitable miner that has found a way to get the lowest cost energy contract. I mean, there's a lot of differences between all of these different offerings. But this issue, we weren't even talking about as a crypto community just 11 months ago. It wasn't on anybody's radar screen. And then all of a sudden you started to hear it, no matter what direction it came from. There's all kinds of people talking about it. But I think it's not a bad thing at all. The challenge with a decentralized asset like Bitcoin is there's no central voice. There are thousands of participants, but there's no committee. There's no, for lack of a better word, lobby group that says, no, these are the actual stats. This is the real information. There's lots of different tangents, but it's an industry that's so nascent, so new, that it hasn't found a way to say, wait a second, we're being accused of all these incorrect facts. We're going to fix this. We're going to put out real information. In the end, the truth is what matters, particularly if you're an institutional investor and you want to know the facts. But I can guarantee you at the institutional level right now, whether it's sovereign or domestic pension or anybody else around the world, they are listening to what government's saying. Norway just pulled its tax credits because they've got a lot of concern at the popular level. The population, the people that live there are worried about it. You've heard the same concerns out of other geographies saying, why are we burning all this power to make a currency? But there's no voice. There's nobody pushing back. And I think this is going to change over time. Either the CEOs of the large mining operations will come together and say, here are the facts about what we do, or the crypto community will somehow take from a decentralized view to a central one to address government's concerns at the state level, at the federal level, and at the international level as well. Bitcoin as an asset is here to stay, and now it's got to get in sync with what institutions want before they buy it.
Thank you. This was OShares ETF Chairman Kevin O'Leary on sustainable investment. Thanks for joining us. Next, to further our discussion about Wall Street's ESG moment, we're joined by Mark McDivitt, who's the COO of Context Labs and the former global head of ESG at State Street. Hey, Mark. So all of a sudden, ESG has become a very big deal in finance. It's moved from the more exotic world of alternative investments to being front and center in a lot of firms' asset allocation decisions. What do you think is driving this shift?
Yeah, no, absolutely. Thank you for having me today at CoinDesk, and thrilled to be here and thrilled to talk about this topic. And Kevin O'Leary nailed a lot of the points that I wanted to talk about today. So that's the joy of going after Kevin O'Leary. So look, investing utilizing ESG factors has really taken off over the past, say, 12 to 24 months, driven primarily by the urgency to address the climate crisis, pointing to the idea of what we can measure, we can manage. And the other key driver is the notion that, look, while ESG has historically been viewed as a values-based discipline, it has finally become apparent to principally the capital markets community that these non-traditional financial risk factors, or ESG, can also help to quantify and drive value or performance of a company. Look, the overarching issue or the challenge that the industry faces, though, is the ability, the word we just been touched on this past 30 minutes, is this idea of trust in data. Data that is often viewed as biased, latent, lacks provenance, lacks veracity, and the correlation often between, say, vendor A and vendor B on the same asset is quite low. The other challenge is that there are a multiplicity of initiatives and standard-setting bodies, all with the best intentions of creating a level of confusion about what data can be trusted, which standard to be able to level set on across all stakeholders. And this is particularly relevant as countries grapple with meeting the Paris Climate Accord targets ahead of COP26 in Glasgow in the fall. So that's a long-winded introduction to say this is squarely how distributed ledger or blockchain technology and the CoinDesk community can play a key role in the ESG investing space, effectively cementing a level of transparency or trust in the data that frankly doesn't exist today. I would say, blockchain technology, go ahead.
No, I was going to say, Mark, I'm glad you touched on the Context Labs, what you're doing, because I was going to get to that in a moment. But just before we do, in your old job, when you headed up ESG investing at a major financial institution, State Street, tell us about what banks and institutions, what the checklist they were having to apply whenever you're sort of assessing the value of an investment, whether it complies or not.
Yeah, great question, Michael. And I think that you used the right word, checklist. Often ESG has been basically a box-ticking exercise where we'll put together traditional investment theses, and then we'll overlay ESG scores to quantify, in fact, that you're utilizing ESG and how you're managing risk and looking at performance and compliance purposing. So that's in a nutshell what we're looking at.
Well, and now, of course, you're at Context Labs, which is applying distributed ledger solutions to a lot of these data challenges you were talking about.
That's right.
So how are you addressing environmental data, and how are you dealing with this trust problem you spoke about?
No, it's brilliant. So blockchain technology is central to the work that we are doing at my firm, Context Labs. We've developed a software platform called Immutably that ingests all sorts of data to include company-reported filings, satellite source sensor, and third-party ESG data sets. Each step of this process, we like to say, is cryptographically proofed and ledgered, thereby rendering the data that we ingest irrefutably trusted, or something that we call asset grade. We're working closely with the oil and gas industry as an example, right? The industry, the sector that is right now in the firing lane with addressing the climate crisis and helping them to tokenize their natural gas, something we call distributed ledger as an example. Another example of how we're using blockchain technology directed principally at the E of ESG is building and will be offering to the market an asset grade environmental attribute that companies can use to offset their carbon emissions, something we are calling an AGD coin. When one buys and retires this environmental attribute coin, one can have irrefutable confidence that the data that is verified and additionality of that project is in fact being irrefutably trusted. Many of you may have seen the announcement a few months back by the Nature Conservancy having to recall carbon offsets sold by BlackRock, JP Morgan, and Disney, because it was determined that these offsets were in fact not adding value to sequestering carbon. This is the kind of headline risk that we're trying to mitigate in using this platform, leveraging blockchain technology accordingly.
Thank you so much, Mark. Mark McDivitt, COO of Context Labs. After a break, we'll be back to talk about tokenizing carbon emissions.
CoinDesk indexes, the market standard for crypto assets since 2014. Our trusted data powers billions in publicly traded funds. CoinDesk indexes are the standard used by institutions, and they're the key for investors looking to understand and access crypto markets.
CoinDesk Bitcoin Price Index, XBX, has been instrumental to Grayscale, enabling investors around the world to access Bitcoin through a regulated, familiar product.
CoinDesk indexes enabled the early adopters to build crypto investment vehicles, and they're already trusted by a new generation of global investors.
Welcome back to Money Reimagined, the ESG edition, where we are exploring the role that digital assets and emerging tech can have in social and environmental change. You know, the world is awash with digital devices that provide mass data on the state of the world. These IoT networks will be critical to measuring ESG performance so that economic actors can make informed ESG decisions in real time. But there's a trust problem to overcome in all this. We need verifiability, international consistency, and transparency, and we need all participants in ecosystems such as supply chains to submit and use data in a standardized, coordinated manner. Joining us to discuss this is CRISTINA, an engineer, computer scientist, serial entrepreneur, and a co-author of a forthcoming book on data and ESG, along with Mark Johnson, who can address this from a data science perspective, and he's from the Rocky Mountain Institute. Welcome, CRISTINA and Mark.
Well, thank you for having me.
So, CRISTINA, in your book, which I had the pleasure of reading in advance of publication later this year, you talk about the need to standardize data so we can all use it consistently. Can you explain for our viewers why this problem needs to be solved?
So, the issue is that we have a variety of different lenses, right? So we have standards. We have GRI, which is about the company's effect on the world. And then you have the opposite, which is SASB, which is the effect of the world on a company, right? Then you have the analysts who utilize a variety of different methodologies by which to do analysis. So I'll give us an example. We've got Tesla, right? Tesla is saving the planet. But yet there are some analysts who will say, well, you know, they've had some problems with the SEC, and that's financially material risk, which is what ESG is about. So looking back, you say, oh, there's a risk there. But others will say, oh, well, the risk is gone because they figured it out from a governance perspective. So the risk going forward is going away. You have a variety of different proprietary data sources. So for example, somebody who's following the industry for beverages might buy water tables from a satellite company, whereas somebody else will take outdated FEMA tables. So you have different types of data sets, you have different types of methodologies, different types of definitions, and then you also have these standards that actually look at industry geography and define ESG all very differently.
Well, so to create standards, though, you need buy-in from a variety of stakeholders, if not all of them, across a particular ecosystem. And in this case, this is about as big of a tent as you can imagine. I got to say, as somebody whose specialty is curating unlikely communities, this is a lot of players. How can we get everyone to the table?
Well, it's interesting, the data piece of this, in the beginning part of the book, we talk about the history and, this whole ESG space, I would say, is a couple of decades old, but the data space is young. It's probably only 18 months old. And so I think that the process of creating these definitions is coming together. You have people like Larry Fink at BlackRock who are singing the praises of SASB for publicly held companies. But then in Europe, you're using GRI. So I think the investment mechanisms for publicly held companies, if as they sort of demand things like SASB, which is much more accounting oriented and it's broken down by industry. I think that as that becomes more popular, there'll be more of a trickle down in terms of what investors will be looking for to invest in ESG compliant organizations.
So, Mark, you're looking at this more specific data sharing issue of emissions accounting within supply chains. And I know the Rocky Mountain Institute has a proposal for standardizing that accounting, which you described in a CoinDesk op-ed earlier today. Can you briefly walk us through that?
Yeah, sure. Well, first, thank you all for having me. It's a pleasure to be here. And just to piggyback on what Christina was saying, we're really looking at this as a key trend that's emerging. There's been, primarily pushed by an influence of consumers, investor, and policy pressures. More and more climate disclosures are driving decisions and strategy. And there's increased interest in making these disclosures financially material. And what that really means is that they're moving from mere line items on financial statements to a point where they play a crucial role in defining what a company does to maximize its market value. And given these dynamics, it's our expectation, or we don't think it's very unreasonable, to expect that these disclosures of ESG metrics, or at the very least, GHG inventories, may become a requirement in US GAAP and IFRS financial reporting within this decade. However, when this occurs, or in order for it to occur, there must be a robust data standard to represent this information in these disclosures. Now, in order for that robust data standard to fully account for the materiality of climate risks, it must comprehensively account for the embodied emissions across supply chains. And with that, I mean, scope 1 and scope 2 emissions, direct emissions associated with an individual stakeholder's operation, but also scope 3 emissions, those indirect emissions that more times than not take up the lion's share of a carbon footprint for an organization, and more times than not are not specifically reported on or accounted for. And furthermore, we believe that there is a crucial need for a system to comprehensively account for all of these emissions to be built in a digitally native manner. Current greenhouse gas accounting practices, standards, methodologies, as well as protocols are more or less guidance documentation that call for manual calculation, data input, and disclosure. We believe that there is a massive opportunity and a massive need to create a system that enables everybody to report in a more verifiable and transparent manner. And as such, we are looking at and developing a system that rests very heavily on utilizing distributed ledger technology to bring more transparency and comparability across climate disclosures of all kinds.
Okay, so Mark, if we take that model that you're developing, hopefully that brings us to a world with richer, more reliable supply chain-wide data. How do we turn that then into something actionable so that supply chain partners can collectively work together sort of to iteratively improve their processes in pursuit of their common interest? How do we actually incentivize them in many respects to build on the data?
Certainly, and you're hitting on a very crucial point of one, the system that we are developing, and two, a forthcoming report that will detail this in more detail and provide more detail of this. Really, we believe that there's a great need to build a system that takes individual components from a number of different domains. A technological solution is not going to be a panacea to solve all of the ailments of carbon accounting and of ESG reporting, but it is a specific pillar of the comprehensive solution. Another crucial piece is the carbon accounting piece. There's still a number of challenges associated with comprehensively accounting for the carbon embedded in supply chains. And we believe for this proposed solution that we need to build on existing greenhouse gas protocol, which is co-developed by the World Business Council for Sustainable Development and the World Resource Institute, to meaningfully improve it in a number of crucial ways, as well as leverage a number of the existing projects and protocols that reside in the blockchain space such as IPFS, such as libp2p, such as potentially some of the implementations of Ethereum or Polkadot, to once again bring more transparency, more trust, and more comparability across these metrics so that they can become actionable and transactable.
So I want to ask both of you a question I always feel compelled to ask in situations like this. And maybe Christina will go to you first, which is, how can a blockchain actually help with the standards problems you identify? Can it?
Well, it's interesting. So I think of blockchain as being the ability to capture a journey of information, right? And so when I think about ESG, I don't think about it just as environmental. I think about it as the social, which is all the different stakeholders, right? And then the governance, the ability to manage all of this information, right? And so what's interesting about blockchain is its ability to bypass the nature of siloed data in a bunch of siloed different systems and be able to see that trajectory across the entire flow and not just within a particular part of a process that's inside a database, right? But when you combine this with things like IoT or other technologies to be able to capture that information, you start getting a fuller image in terms of where something is sourced from. What was the labor policy with respect to the people that were involved with it? And you can start to capture a lot more of that information in sort of an immutable way, because I think that that's one of the biggest issues with respect to, for example, consumers want to buy products that were built in a sustainable way. But if you can't look all the way down a supply chain and be able to see how it was sourced, what are the materials, how was it built, then it's very difficult to actually know that what you're buying or consuming is actually built in the sustainable way that you would like it to be, right? So while the standards for that don't really exist today, I think that the technologies are there to be able to capture those journeys of information that give that kind of visibility to a consumer or an investor.
So, Mark, what do you think some of the challenges are then with integrating distributed ledger architectures into this context?
Yeah, sure. First, I just want to make a point on Christina's remarks there, which I wholeheartedly agree with. I think that leveraging blockchain for this need allows us to design end-to-end audit trails that showcase or provide at least a higher level of granularity and of assurance of the who, the what, the where, the when, the why that events took place as raw materials move through supply chains or connected value chains to get to end-use products. And that provides a tremendous amount of benefits to end consumers, of course, but also crucially, it allows us to attribute the emissions associated with the production of products to the appropriate people. Once again, going back to the challenges of comprehensively accounting for emissions associated with supply chains, accounting for the scope 3 emissions, the indirect emissions associated with operations, is a very large barrier into making meaningful impact into creating climate differentiated products and services. Now, with regard to your...
Mark, I was going to say, we're going to have to come back and ask you about the challenges later because we're going to get tight for time. So it's a good excuse. You've left it open for us. We'll bring you back and we'll chat about those. But thank you to you both, Christina Dolan, Inside Chain CEO, and Mark Johnson from the Rocky Mountain Institute. Okay, we're going to take a quick break, and when we come back, we'll get introduced to the Universal Carbon Token.
Digital finance is changing communities. From fueling local economies to connecting global markets, the future of money is taking shape now.
CryptoState by CoinDesk will bridge communities of crypto investors, thought leaders, and developers from around the world.
Together, we will tell the global story of decentralized finance. Join us for this virtual event series as we make stops in Nigeria, the Middle East, and Southeast Asia to dive into the movements that are disrupting markets around the world. Network, learn, and get insights from the builders, thinkers, and doers of tomorrow. Register today.
Welcome back to Money Reimagined, the ESG edition. We're exploring the role of blockchain and crypto in achieving ESG compliance and reaching global sustainability goals. So far, we've talked about the role blockchains might play to improve the recording and sharing of ESG relevant information like emissions data. The next step is to consider how to tokenize that information to create liquid, investable digital assets that encapsulate the value it expresses. To discuss this, we're joined by Paul Brody, the Global Innovation Leader of Blockchain Technology at Ernst & Young, and JP Theriault, CEO of Uphold, which leads the consortium behind the Universal Carbon Blockchain. So first, Paul, you've been a strong supporter of public blockchains, and other consulting firms went for a private blockchain path. And of course, the one big critique of public blockchain is that they face scalability challenges. Will they be ready for the amount of money and data involved in this global undertaking, which some estimate as much as $150 trillion over the next 30 years?
Yeah, I mean, I've got a lot of confidence that public blockchains can handle this, right? So the markets are liquid, the markets are highly investable. There's great progress being made both in terms of the carbon consumption, the carbon footprint of this technology, as well as the scalability. So I'm very optimistic about the ability and actually the usefulness in blockchain technology in meeting these challenges.
Hey, Paul, your team has done research into how we tap the kind of vibrant market model that we've seen in the blockchain and crypto space, and how we apply that perhaps to inspiring climate change innovation. Can you explain what you mean by that and what sort of a vision you have?
Yeah, I think we've got really sort of kind of 2 or 3 really important goals. Number one, we really want to make ESG an investable asset. And it's the kind of investable asset that you can put into the DeFi ecosystem. And so what's been amazing about DeFi and Ethereum is that you can take these assets, right? And they can be things like carbon credits, they can be renewable energy credits, they can be all kinds of things, and you can put them to work in terms of obtaining financing and generating cash flow. So the first goal for us is let's make DeFi turn ESG into an investable asset. And then the second goal is the one that one of your prior speakers talked about, CRISTINA. She was talking about trustworthy data, right? We believe that's an incredibly important thing for an audit firm to have a role in, and we want to make sure that people can invest with confidence in these renewable and ESG certified assets.
So, EY is one of the big 4 accounting firms. And, we've often talked about how the world of auditing, the jobs of accountants might change in a world of blockchains. So if blockchains are going to allow us to audit transactions automatically, what is the role for the accountants in all of this?
So the whole world of assurance today is relatively somewhat backwards looking, right? When auditors sign off on an audit, they basically say, do we believe that a firm is stating truthfully what they have done? And what we are looking forward to is more systems focused on verifying data in real time, right? And so there's a concept called attestation or SOC reporting, which stands for Systems of Controls. And this is where we look at what's in place to make sure that the company is reporting data correctly in real time. So the goal, I think, in a forward-looking way, is shifting the role of assurance and audit towards can we verify the data as it's being reported so that you can transact upon that data without having to verify all of it yourself personally?
One challenge we have, Paul, that you alluded to is the garbage in, garbage out problem, right? The idea that if we can't rely on the data, if we can't trust it, then what insight are we actually getting? And even, though some records might wind up being pristine based on how tokenization models are working, how do we really know that we can trust the data that's coming from any sort of source? How do we decide what Oracle is even trustworthy in this context?
So this is where I think kind of the Oracle technology is really cool. So there are oracles that are thinking about multiple data sources, but the biggest challenge we foresee on the horizon is the source for many critical pieces of information are going to be a single enterprise, right? And they're going to be the only people who can say whether or not they did something in a very timely manner. And so the issue there is, can you have a third party validate that enterprise is documenting and reporting their information correctly? And that's what a system of controls report stands for, a SOC report. So if somebody says they're doing a SOC report on something, what that means is someone's inspecting the process of how a company gathers and reports data and verifying that it's being done in a reasonable and consistent manner. It's not maybe quite a guarantee, but it's a higher standard than just a single enterprise by themselves saying, well, no one else can real-time verify this, so just trust me, And that's what our aim is to do, is to increase continuously the level of trust that can be delivered against the information flowing onto the chain.
Paul, give us an idea perhaps of what a digital asset world might look like where there is truly a global liquid market for this.
Well, obviously, one of the most common ones are things like cap and trade concepts, where companies have said that they will cap the total amount of carbon that they spend, or they will publicly commit to getting to carbon neutral. So my goal is to do a couple of things. First of all, can we help companies tokenize both their consumption and their offsets? And then secondly, can we help create a global marketplace where you can take a commitment from an enterprise to go carbon neutral or carbon negative and turn that into cash that can be used to generate offsets or renewable energy? And I think that's the part that's not yet worked out yet. But my goal is to figure out how to turn these enterprise level commitments that are being made individually in the absence of a really structured global treaty, turn those into investable assets that can pay for the enormous amount of capital that's going to require to transform the global energy infrastructure.
And do you think, Paul, that there is agreement from a wide enough, let's say, variety of actors on, what data is needed and what kind of form this reporting needs to take and what these standards ought to look like?
No, there definitely is not, right? And so I hope to, and one of the things that got me very excited when you and Michael came to us to talk about the CoinDesk ESG and the consensus discussion here is we would like to be part of that discussion. We want to participate. And when we look around, we don't see a tokenization standard. We don't see an agreed upon methodology. We don't see enough maturity in the market making mechanisms to do all of these things. We sort of know where we want to go, and we talk to our clients who have made enormous commitments and are willing to put significant money behind those commitments if we could all agree upon standards and tools and mechanisms for implementing those and turning those commitments into green and renewable energy investments, for example.
Okay. Well, thank you to Paul Brody, Innovation Leader of Blockchain Technology at Ernst & Young. And unfortunately, we didn't get to talk to JP Thiro, who's the Uphold CEO, would have given us some insights into what they were doing. But Paul, it was a pleasure to talk to you, and thank you for your interest in this project that the World Economic Forum and CoinDesk is spearheading. So thanks all of you. You're most welcome. Thanks all of you for joining us for the first episode of our two-part special Money Reimagined ESG edition. Tomorrow, the discussion continues and we ask, can Bitcoin really go green? In the meantime, check out some amazing content and speakers we have in store for you at Consensus this afternoon. There's an exploration on crypto asset management. And later, another exploration on ETH2, smart money and the multi-chain future. I'm Michael Casey. Thank you for joining Sheila Warren and I, and we'll see you tomorrow. Coming up at 7 p.m. is a special 1-hour edition of The Hash.
The financial world is evolving fast, and we're adapting to meet the new demands of this growing industry. That's why we're introducing Desk, an integral part of this modernization. At Consensus, you can earn Desk by completing a variety of fun tasks, such as attending virtual networking or interacting with our online event platform. Desk holders are able to redeem tokens for a range of Consensus-exclusive NFTs, including swag, products from our partners, and one-on-one meetings with VIPs. Desk is a CoinDesk-issued ERC20 token created in collaboration with NFT management system Unifty. It's hosted on an Ethereum-based testnet called Rinkeby. Desk does not have a monetary value and cannot be traded for other digital assets or fiat currency. The Taurus wallet has been chosen to support the rollout of Desk. The Desk beta is open to current and previous attendees of Consensus, as well as attendees of our Unlocked 101 series. All you need to do to start earning is head over to coindesk.com/desk, enter your email, and claim using your access code. Make sure you're registered for Consensus by CoinDesk 2021 to get in on the action.